What's going on, guys? Welcome back to another video. In this video, it is going to be the first update in a series of video where I kind of go over all of the different option strategies that are out there, and I give my opinions on how you should use them trading in your everyday trading activities. Now, before we start going over anything, what options are or anything, I just want to let you guys know that options trading is extremely risky. You guys always hear me say in a lot of my videos that I never trade with an amount that I am not willing to lose completely. So that amount for me right now is between $250 and $1,000. So that's the amount that I take on every options trade, and it fluctuates throughout that range depending on how much conviction I have on the trade. So some option strategies are very low profit percentage but very high profit potential, and that's why I like them. So in some respects, it is gambling. So you do want to stay away from some of these strategies if you are a beginner. So I wouldn't recommend anybody trade their entire portfolio in options. You always want to have a safe long-term portfolio, and trading options with a small amount is a really good way to supplement your long-term investing goals. So this video is really going to be about the basics. I want you guys all to have a good foundation and know exactly what options are before you start trading them, because I don't think that you really should trade anything that you do not fully understand. So let's take a look down in this Google Doc that I prepared. So what are options? So in general, options contracts give the owner of the contract the right but not the obligation to buy or sell 100 shares of stock. So let's break that down a little bit. So an options contract controls 100 shares of stock. So you can make bullish bets, which you think the stock is going to go up, or you can make bearish bets where you think the stock is going to go down. Now, you own the right for a future date at a specified price to buy or sell 100 shares of that stock, and the value of that contract will fluctuate throughout the time until expiration. So now let's take a look at some of the two very important aspects of options. So there's calls and there's puts. So calls are bullish, and they give the owner the right but not the obligation to buy 100 shares of stock at a predetermined price on a specified date. So when you go to buy a call option, you are going to pick what is called a strike price, which we are going to get into a little bit later in this video, and you are going to pick an expiration date. So that is going to be the date that the options contract expires, and you will have two options if you hold to expiration. You will actually have three options. You can either sell your actual contract on the day of expiration, you can exercise your contract if it goes past the break-even point, which we are going to be going over later. Or the third option, you don't really have a choice, but the contract expires worthless and you need to move on. So the next aspect is going to be puts. So these are bearish. Classically, these are mainly as insurance, and you're going to see why after we go over this. So if you buy a put and you are the owner of the contract, you own the right but not the obligation to sell 100 shares of stock at a predetermined price on a specified date. So if you own a pretty massive position in any given stock and you don't want your position to go down below a certain point, you can hedge your position with puts, and say the stock is trading at $100 and you don't want your position to go below $90. So say you have 100 shares, you don't want your position value to go below $900 or $9,000. So what you would do is you would buy puts at the $90 strike, and you would have the right to sell all of your shares at that strike price. So now let's go over an example of a call option so you guys can understand it a little better. So let's say that stock A is currently trading at $100 and you think that this stock is going to be worth more in the near future. So here's what you do. You buy one call option contract at the strike price of $105, and that is the predetermined price that we discussed earlier, and this contract costs you $1. So when you take a look at an options chain, you're going to see a lot of these like low prices. You're going to think that, ooh, I could get into this for $1. that is not the case. Each options contract controls 100 shares of stock. So every price that you see on an options chain, you're going to have to multiply it by 100. So when you see a dollar like this, that contract is actually going to cost you $100. So in order for you to make money on this contract on expiration, that's the key point. We're going to talk about actually holding these contracts to expiration first before we get into the valuing the contracts before expiration. So the break-even point on this contract. So in order for this contract to be profitable on expiration, the stock needs to be trading at $106. Now, why does the stock have to be trading at $106 if the strike price is $105? Well, you actually paid $1 for this contract and you own the right to purchase 100 shares. So if the stock goes to $105 and you go to exercise this contract and buy 100 shares at $105, you will actually lose $100 by doing this because you could have just waited and bought the shares at $105 on that date. So if the stock is trading at $106, you will actually break even. And if you exercise your position, which means you actually purchase the actual, you exercise the contract and purchase the 100 shares, you will be even for the trade. So now if at the closing bell on expiration, the stock trades at exactly $105, now this is only theoretical, your options contract would expire worthless. And that's because you got to think about the market for these types of things. Why would anybody pay you to actually buy 100 shares of a stock if they could just go out on the open market and buy it at that price anyway? It doesn't make a lot of sense. So we can take a look a little bit down here at options pricing. So there are two aspects that make up the value of an option, the intrinsic value and the extrinsic value. So the intrinsic value is going to be the difference between the strike price of the contract and the current trading price of the stock. So if we go back up to the actual example, we can see that stock A is trading at $100. If you were to buy the $95 call, for this stock, you would actually have an intrinsic value of $5. So that would be a $500 intrinsic value. Now, out of the money options, which means you buy an option that is above or below. So for calls, if you buy a options contract with a price above what the stock is currently trading at, that is considered an out of the money option, and that will have no intrinsic value because you can't exercise the contract for any value. So if we come down a little bit more, we can see that extrinsic value is going to be all about the time value of the contract and implied volatility. So this is a nice graph that kind of goes over what the price of an options contract will be on expiration. So this is only on expiration. This does not tell you what the actual fluctuations of the price of an options contract will be in the time between when you bought the contract and the expiration date. So we can see right here, so this is a long 40 call. So basically going long means that you are bullish. So $40 call at $1.50. So they show here on the graph, it's kind of hard to see, but the break even is going to be $41.50. And if it's anywhere below that on the expiration date, you will lose the entire amount of money that you put into the position. So that's why I say that options are extremely risky. A lot of people say that about 90% of all options contracts expire worthless, which is true, but that does not mean that you cannot make money before the expiration date. So let's go over what actually gives options their value. So this all has to do with the Greeks. So there's four main Greeks. There's delta, gamma, vega, and theta. So delta is a very important Greek. It measures the sensitivity of an option's theoretical value to a change in the price of the underlying asset. So the delta is represented as a value between -1 and 1 and represents how much the value of an options contract should change if the underlying stock moves $1. So let's get into this a little bit more. Calls have a positive delta since they have a positive correlation. And puts have a negative delta for the same reason. So let's go over an example of this. So if you guys remember the example that we just discussed when we were talking about stock A, when it was trading at $100 and you bought the 105 strike for $1, if the contract that you bought has a delta of 0.3 and the stock rose $1, so the stock went from being $100 to $1, $1, then you would expect to gain $30 on your contract, because you do the same thing when you look at the Greeks. You multiply it by 100, so you would expect to gain $30 or 30% on that contract. So you would turn that $100 investment to $130. Now this is oversimplified. Usually out of the money contracts have deltas below 0.2. And then we can move on to gamma. So gamma measures the rate of change in delta. So if you are a math guy or a math girl, this has a lot to do with calculus. It measures the rate of change for delta for each $1 increase in the underlying asset. So then we can come down to theta. Theta is very important. So theta is the time decay. So it's the dollar amount an option contract will lose as each day passes. So if the stock stayed the same, the theta amount is going to be the amount of money that your options contract will decay or lose value as it gets closer to expiration. But if you get more time on a contract, as I have noted here, there is less time decay per day. So when you trade weeklies, there's usually a pretty high theta, and if the stock does not go up at a very fast rate, then your options contracts will lose value. We then come down to Vega. So Vega is, it measures the sensitivity of the price of an option to changes in volatility. So an increase in volatility usually leads to higher priced options. So as you've seen in some of my other videos, I talk a lot about the implied volatility on an options chain. And when there's a higher implied volatility, I usually don't put as much money into the actual trade, because when there's a really high implied volatility, you're paying a significant premium in order to get into these positions, because there is a higher projected move in the stock price. So if you guys have seen some of my other videos, I showed you how to actually calculate the projected move of a stock by using the options chain, and that's a very valuable tool to have. So these are kind of the basics. If you guys have any questions about the basics of options, please comment down below your thoughts. I'm going to answer all of your questions. So if you have any questions, comments, or anything about this, please comment down below your thoughts. I know options can be a little bit intimidating, but once you understand them and you know how to navigate the options chain, they become a lot more simple and you understand how to trade them. So the next video that I'm going to be posting about options, we're going to go over some of the strategies and some different ways that we can actually trade them by buying calls or puts, debit spreads, credit spreads, butterflies, iron condors, everything. So if you guys want to see more of this, please drop a like on this video and comment down below your thoughts. I really hope that I provided you guys with some value and some better insight onto what options actually are. So I hope you guys are having a great weekend, and I'll see you guys in the next video.